All right, in this video, we're going to be talking about business cycles, often referred to as economic cycles. Now, a business cycle merely represents a fluctuation in business activity that an economy, whether it's the US economy or another economy, experiences over a period of time. Now, studying business cycles or economic cycles is really helpful for a couple reasons. The first of which is it helps businesses or business owners and managers be able to make decisions regarding how to run that business. So you might see that the economy potentially is going to dip into a recession, and that might play a role in your decision making as whether to increase staff or whether to make investments into equipment or other things. Likewise, if you see that the economy is improving and is kind of coming into what we would call an expansion, you might make a decision to make further investments to be able to kind of take advantage of that expansion. For individuals, much like us, knowing the economic cycles can help us make investment decisions. So depending upon what our investment interests are, whether they're stocks or bonds and those types of things, there are certain types of stocks that are better suited for different stages of the business or economic cycle. So before I get too much into that, let's kind of talk through this graph here that you're looking at. So you can see here towards the left-hand side of your screen, on this axis, we have what we would call real GDP. GDP, of course, represents gross domestic product, which is the dollar value of goods and services produced in an economy over a period of time. So whether it's a quarter or a year or even a month, although you commonly see this reported on an annual basis as well, so you can kind of see the adjustments and the potential movements in the economy. On the next axis, we have time, and so this is just progressing forward. It's not meant to denote any particular period of time, just rather time in general. And then, of course, we have this trend line, which is just meant, of course, to show the natural kind of trend upward. As you can see, this line is gradually moving upward, but along the way, while we are moving upward overall, we certainly have some peaks and some valleys, and that's where we get the economic cycles that reflect how we're doing economically, which in turn impacts how we're doing as consumers. So looking at this, there are a couple of different stages that you can see through the natural ebb and flow of our economy. So this rising period here that you see, this is what you would call an expansion. Now, an expansion, as you know, is the increase in GDP and is important for a variety of reasons. Not just that itself is an expansion, but it's important because what that means for individuals and businesses in the economy. So expansions typically result from an increase in spending. So our economy, especially here in the US, and this is characteristic of most free market economies as well, is largely is sort of reliant on how much consumers spend. So I think about 2/3 roughly of GDP is based upon consumer spending. So when looking at these peaks and valleys, you can usually look back and say, okay, what was consumer spending like? And that's pretty much the determining factor. Because when there's increases in spending, this creates a lot of opportunity. This creates opportunity for businesses, which in turn hire, produce more goods, make investments, and then of course, it further helps consumers in the terms of employment. So commonly with expansions, you see a couple of different things happen. You typically see increases in employment. You typically see increases in production. Usually increases in sales from a business perspective, and then you also see increases in incomes at the consumer level. So for all intents and purposes, expansions are really good. We like expansions, and we would love it if our economy just expanded all the time. But the reality is that our economy is a byproduct of kind of business activity, and we know that at some point things cool, recessions take place. There are other events that happen, like the housing crisis, that of course cause this kind of immediate correction, if you will. And as a result, things can't keep going well for so long. So eventually we get to this top period here, and this is where we call the peak. This is the top point in the expansion. This is like the top of the roller coaster. And so now we begin to plunge down further and further until we get to kind of this lower period here. Now, as we're continuing down, this next section is what we would call a recession. Or rather, generally speaking, I can use the terminology of a contraction. So economies contract, and that's just a natural kind of component of the economy. And that means now that our GDP is declining. Now, the way that we describe that, we can specifically use the terminology of a recession, which specifically is when GDP declines for 2 quarters. So whenever you see this GDP figure decrease for 2 consecutive quarters, consecutive, so you can't be one and then a good period and then a down period, it has to be consecutive. Then we have a recession. And if it's really, really bad, like, 2 quarters and beyond, well, then we'll throw out the terminology of a depression, which we've used really only once, in the past 100 years or so, given the 1920s and 1930s. So a contraction is bad because it essentially produces the exact opposite of an expansion. Now remember, where expansions are driven by consumer spending, contractions, of course, are driven by decreases in spending. So after the 2008 housing crisis, spending dropped significantly, in large part because of housing and because people were losing their homes and foreclosing. And as a result of that, that tends to drop spending. The housing market itself was in disarray. And as a result, you really felt that, broadly speaking, across all aspects of the economy. So with decreases in spending, you eventually, of course, businesses now realize, hey, people aren't buying our stuff. So now we have to lay off people, which in turn, of course, you have a decrease in employment, not unemployment, but a decrease rather just in employment. You have a decrease in production. You have decreases in sales. And then eventually you can get to the point where you either have a decrease or stagnant incomes, which is actually really, really bad. So people's incomes aren't going up. You might have inflation, of course, which is the increased price in goods and services. And incomes might not be keeping up with that, which is really bad because you have less money overall to spend on the things that you normally buy. And so that's what tends to happen. Now, once you get to the very bottom, this period here is what we would call a trough. This is the bottom point in the contraction. And then, of course, we get to ride all the way back up and go through it again. And notice it is cyclical. And it sounds like insanity, I know, but it is cyclical, meaning that we are going to experience expansions and contractions. And regardless of what the Federal Reserve does or any kind of fiscal policy measures, we are going to experience those things. Now, just for kind of more information, the government entity, the National Bureau of Economic Research, is actually in charge of identifying when these expansions and contractions take place. And so they use historical data and then make decisions on, okay, this is when the contraction started, and this is when it ended, and this is when the expansion period began, and all those different types of things. And so this is interesting because it just kind of gives you an idea for how long these things last. So a expansion specifically lasts for approximately 58 months. And this is based upon data obtained, so using economic data from 1945, I believe, so post-World War II, all the way to present time. Expansions last about 58 months. So that's roughly about 5 years is how long expansions last. Now, if you're kind of looking at your calendar right now, thinking like, hey, what's going on now? You'll notice pretty quickly that this expansion has lasted longer than 5 years. We're kind of going on roughly about, I think, 10 or so. So we've had a relatively good period overall, although not everyone in the economy has felt that expansion the same way. Now, the other side of things is, of course, the contraction period. And so contractions, probably wondering, well, how long do those last? On average, contractions last about 11 months. So certainly not as bad. But again, it largely depends upon how deep into a contraction the economy goes. At the worst of the Great Recession, which was caused by largely the housing crisis, we had very significant unemployment. So that's roughly how an economic cycle works. Now, of course, it's really hard to predict these things, but you can look at things like GDP inflation, unemployment, yield curves, and other economic indicators to help kind of paint a better picture as to where the economy is going, although it's really, really hard to predict with 100% certainty as you've seen through the past.